The Bank of Canada decided to hold the interest rate at 5%. Now, this was something that was widely expected. In our last inflation report, it actually came down, and we know that that is one of the key metrics that they're using in order to make their decision for future interest rate hikes. But that is not what we're covering today. We're actually going to be going into the weeds a little bit. They had a meeting after they made their decision, and they covered some important topics that I think I should bring to the limelight. First and foremost, the persistent inflation. When can we expect this to go away? We'll talk a little bit about fiscal policy. There was some shots fired, in my opinion, in regards to the fiscal policy. And then we'll talk a little bit about stagflation and finishing it off with when could rates potentially be cut. For those of you who don't know me, my name's Nick and welcome to Ways to Wealth. We are going to start the video off by talking a little bit about what we can expect for inflation moving into the coming years. And we've heard a little bit of a change of dynamic. I'll let Tiff do most of the talking, but what you're going to hear right now is that inflation continues to be sticky.
But our outlook for near-term inflation is higher. Let me explain. The effects of higher interest rates are most evident in the prices for durable goods like furniture and appliances that people often buy on credit. And these effects have also spread to many semi-durables, a category that includes things like clothing and footwear, as well as many services excluding shelter. Inflation in these categories is now running generally at or below 2%. Price increases for groceries, while still elevated at almost 6%, have also eased and are expected to moderate further. Despite this, we've revised up our outlook for inflation. Higher energy prices, structural pressures in our housing market, and stickiness in underlying inflation are all slowing the return to target. Higher global oil prices have driven up gasoline prices, and we now expect oil prices to remain higher than we assumed in July. Inflation in shelter services is running above 6%. Part of this is due to higher mortgage interest costs following increases in our own policy interest rate. But it also reflects higher rents and other housing costs, and these pressures are more related to the structural shortage of housing supply. Finally, near-term inflation expectations and wage growth remain elevated, and corporate pricing behavior is normalizing only slowly. All this is making underlying inflation more persistent. The combined impact of all these factors is that we now expect inflation to be about 3.5% through till about the middle of next year. As excess supply in the economy increases, inflation should ease further in 2024 and reach 2% in 2025.
Now, it was originally anticipated that inflation would start to go in between range, between 2 to 3% by middle of 2024, that summertime period. Now we're starting to hear the dynamic change from Tiff that this could be going all the way to the end of 2025. What does that mean? Higher for even longer. This is something that I think we have to take into consideration, that high interest rates are a thing of the new norm. We are not going to see those low 1% interest rates that we've seen over the last decade. I think we need to start changing that dynamic, that mindset that we have in our head that's been ingrained. Additionally, we'll move on to a little bit of an interesting point when it comes to fiscal policy. Tiff will explain a little bit about the difference between what he does and what the government does, and why that could hamper what inflation looks like, especially over the coming years.
First thing I need to say on fiscal policy is that we don't set fiscal policy, and fiscal policy is appropriately the decision of elected officials and ultimately parliaments. Governments have a lot of priorities. It's a difficult job. If you look at our forecast in the Monetary Policy Report, what you can see is that when we add up the spending plans in the budgets of all levels of government, provincial, federal, for next year, we expect government spending to grow at about 2.5%. What that means is if all those spending plans are realized, government spending will be adding to demand more than supply is growing. And in an environment where we're trying to moderate spending and get inflation down, that's not helpful. More generally, what I would say is that governments are hearing from their constituents. They are thinking more about the impact of inflation. They're thinking more about the impact of higher interest rates. And I think that's a good thing. And in that regard, it would be helpful if governments considered the inflationary impact of their spending decisions when they're making their spending plans. It's going to be easier to get inflation down if monetary and fiscal policy are rowing in the same direction.
I have to applaud Tiff here in the way he's been able to address the fact that governments are spending at all-time paces without consideration as to what that is doing to the Canadian citizen in regards to their impact on inflation. They are printing money. I know there's a lot of debate about what that term means, but they are creating money supply. They are creating money supply, and this is something that is going to hurt not only our consumer pocket, but the devaluation of our currency. And I think this is something that we really need to focus on in the next couple years, especially with inflation being at these persistent levels. Now, will the governments understand this and take this to heart? Who knows? We've seen Trudeau backtrack on a carbon tax for the East Coasters with oil, and that's what they use to heat their homes, but hasn't seen that to other Canadians. So we're still early days on that, but what the main point is that governments need to watch their spending in order to help work with the monetary policy, which is actually under the control of Tiff Macklem. Now we're going to talk a little bit about stagflation. Stagflation is something that we've covered on this channel before. It is not a happy period. You have high inflation and high unemployment numbers. So what that means is the economy is kind of chugging along, and this is what is meant by the lost decade. We could head in to a 10-year period where the economy is stale, not doing much, and a high number of unemployed people. So let's listen to what Tiff has to say about that.
I grew up in the 1970s. Stagflation to me is a period of high inflation and high unemployment. That's not what we're in now. It is true that, in this forecast, we've revised down our growth forecast and revised up our inflation forecast in the near term. So what is going on there? And what I want to underline is we can actually see, and I think box 4 in the monetary policy report does a good job of digging into this. You can see the effects of higher interest rates cooling the economy. You can see that transmitting into lower inflation for many goods and services. But the problem is there's some things that are getting in the way. And in particular, higher oil prices and the structural supply shortages we have in our housing market. So combine that with wage growth that's running at 4 to 5%, inflation expectations that are sticky, and corporate pricing behavior that hasn't normalized. All that means is creating more persistence in inflation than we'd hoped. So yes, we have lowered our GDP forecast and raised our inflation forecast. Ultimately, that slowing in the economy is going to build up excess supply, and ultimately that will bring inflation back down to target. But it is going more slowly than we'd hoped.
Some of the things that Tiff mentioned there in terms of lowering the GDP guidance and pushing those goalposts as to when inflation could potentially come down is already starting signs of a stagflationary economy. Now, I know he's doing his best job to be positive, saying that there will be excess supply, but in reality, it seems like we are going to keep kicking this can down the road. We have some wage growth concerns, which we've talked about in previous videos. If wages continue to grow, people will be able to pay the inflationary prices, and we could potentially see inflation spike again, which we saw in the 70s. Now, I'm not here to play fear tactics. History doesn't repeat itself, but it does often rhyme. So things that you need to be considering in the back of your mind right now is that inflation is not done. It's not over. I don't know when that's going to be, and neither does the Bank of Canada. So they can only assess what the latest report is. We're always looking in the past to see what's happening, but we know the economy is soft. We know that there is opportunities right now for a stagflationary environment over the next 5 to 10 years. But taking that all into consideration, the Bank of Canada does have a tool. They do have something that they could do in the next couple of years to kind of help the economy along. and that is an interest rate cut. So let's listen to what Carolyn Rogers has to say about when we could potentially see an interest rate cut.
Well, look, we target inflation. We don't target interest rates, and we in particular don't target mortgage interest rates. We do track mortgage renewals as one of the key transmission mechanisms for monetary policy. We are aware that as we approach sort of the next couple of years, we do have a good portion of Canadians that are renewing from particularly low levels in their mortgage, and that will have effect on spending. I don't think that we view those at odds with our growth forecast. It is something we pay close attention to. Ultimately, as the governor said earlier, the discussion around when we can decrease interest rates has to do with inflation. When we see inflation is sustainably back to target, that's when we'll start having a discussion about reducing rates.
And that's not the first time we've heard that. We know the Bank of Canada has one job: to get that inflation number in between 2 to 3%. That is their target, and obviously closer to 2 the better. They are not concerned about the housing market. Obviously, we did see them pause this week, and it could be up for debate in terms of if we'll see potential future hikes. But at this moment, it's kind of a wait and see period. And that just happens to be the situation today. Looking back at some of the things we've heard today, inflation now not expected to come back into range until 2025. In the last meeting, it was previously mid 2024. So we keep seeing that being extended. We've talked about government spending, how that is not helping what the Bank of Canada is trying to do and impacting where inflation could potentially be in the future. We've talked a little bit about stagflation, how Tiff doesn't see it right now, but the fact that they've revised GDP lower and the fact that more cuts are coming in terms of employment, we could see that unemployment rate start to rise. It is definitely a concern that I'm watching out for, not to be totally bearish, but we have to take these things into consideration. And finally, when can interest rates be cut? When inflation comes back down into range. So we're looking at a prolonged period of higher interest rates, at least till 2025. I don't know when in there, but probably towards the end is the mindset that I have. In reality, if anything doesn't fall off of a cliff, if the economy does not completely capitulate, we will see these higher interest rates for even longer. So I hope you enjoyed the video. If you like this type of content, we cover this all the time. Check out some of the videos I've done before about the Bank of Canada and the interest rates. I hope you all have a great week in the markets. Happy investing.